Welcome back to the Deep Dive, where we cut through the noise and deliver pure, actionable strategy directly from the source material.
Today, we are diving into something that can be, well, a huge source of savings, but also a huge headache for families.
We are talking about the Dependent Care Flexible Spending Account, the DCFSA. It's probably one of the most powerful, but also one of the most intensely frustrating tax shelters out there for working caregivers.
It is an absolute must-use benefit, but only if you really understand the rules. I mean, this whole thing operates under Section 129 of the IRS Code. It's part of what employers call a cafeteria plan.
Right, and our sources today are primarily IRS Publication 503, which, lays out this very restrictive framework.
It does.
So our mission today isn't just to summarize those rules, it's to really extract the strategic knowledge you need to maximize your savings.
And, critically, how to avoid the common pitfalls. It's especially as we look ahead to open enrollment and this massive statutory limit change that's coming in 2026.
Okay, so let's jump straight to the money. Why should people even bother with this?
It comes down to one core concept we call the dual tax shield. The money you put in is deducted pre-tax, so it shields you from federal income tax, just like, say, a 401k contribution.
Okay, that's pretty standard for these kinds of accounts.
But here's the crucial difference. It also shields you from the 7.65% mandatory FICA payroll tax. That's Social Security and Medicare.
Wait, let's stop right there. The FICA avoidance. That's the real game changer, isn't it? Why is that so much more powerful than other tax shields?
Because FICA is usually just unavoidable. Most of the big tax deductions, your standard IRA contributions or even the child tax credit, they only help with your federal and state income tax. They do nothing for that FICA tax, which hits every single dollar you earn up to the wage cap. When you use the DCFSA, that money completely bypasses FICA.
So let's put that in real numbers. If I'm in the 22% federal bracket and I also get to avoid 7.65% in FICA, I'm getting a guaranteed, almost 30% back on every single dollar.
It's 29.65% right off the top, before you even factor in state taxes. So yeah, for most people, it's an immediate guaranteed savings rate of 30% or more.
That is how you pay for dependent care with deeply subsidized dollars.
Precisely. You really can't beat that kind of immediate guaranteed return.
Okay, we've established the savings are massive, so now we have to talk about the operational mechanics, because this is where people trip up and, frankly, lose that money. First hurdle, the irrevocable election.
Correct. The DCFSA requires this annual irrevocable election you make during open enrollment. You pick a total amount for the year, and that's it. You're locked in.
Unless you have a qualifying life event, a QLE.
Right, unless a QLE happens.
Yeah.
And it doesn't just roll over year to year. You have to sign up again every single time.
And this brings us to a moment of mandatory clarity. We have to differentiate the DCFSA from its cousin, the Health FSA, or HFSA. What is the fundamental difference in how they're funded?
This is maybe the most important distinction. The Health FSA is pre-funded. You elect, say, $3,000. And all $3,000 is available for you to use on day one.
Even if you've only made one payroll contribution.
Exactly. The DCFSA is the complete opposite. It's strictly pay as you go.
Okay, so let's talk about the cash flow implications of that. That sounds tricky.
It can be. It means you can only get reimbursed for the amount you have actually contributed from your paychecks so far in the year.
So give me an example.
Let's say you elect $5,000 for the year, and you have a huge $3,000 summer camp bill that's due in June.
Right, a big lump sum.
If you've only had, say, $1,000 deducted from your paychecks by that point, your plan will only reimburse you $1,000 immediately.
So I'm out of pocket $2,000, even though I've signed up for the benefit.
For a while, yes. You have to wait for your future paychecks to contribute more to the account before you can claim that remaining $2,000. It's a critical cash flow difference.
That is a paramount distinction. And that brings us back to the forfeiture risk, the famous use it or lose it. Since DCFSAs don't have a carryover, what's the only way an employer can soften that blow?
They can offer a grace period. It's a 2.5-month extension, usually until March 15th of the next year.
And what does that let me do?
It only lets you incur new eligible expenses against last year's money. It doesn't let you roll the cash forward. It just gives you a small window to spend down that remaining balance before it's gone for good.
Got it. And as we said, changes mid-year are tough. It has to be a real qualifying life event, like a marriage, divorce, birth of a child.
Or, and this is a key one, a change in the cost or coverage of your dependent care. That can also trigger a QLE.
Okay, now that we know how it works, let's turn to compliance. We need to go through these three compliance walls the IRS puts up. You have to pass all three to keep that 30% savings.
These are the three pillars, and every single claim has to clear them. Pillar 1 is the work-related expense test.
This one sounds simple. The expense has to be so that you and your spouse, if you're married, can either work or actively look for work.
It sounds simple, but there is a massive trap buried in that rule. It's the looking for work part.
Uh-oh.
You can use DCFSA funds for care while you're job hunting. However, if you get to the end of the year and you never found a job, and so you have zero earned income for that year,
The expenses become ineligible.
they become ineligible retroactively, yes.
That feels incredibly harsh. So a parent could spend 6 months looking for a job, spend thousands on care, but if they don't land a job by December 31st, they lose the benefit and get taxed on that money.
Unfortunately, yes. The IRS standard is rigid on this. The expense must ultimately enable earned income. If the income never shows up, the expense is disqualified.
So the general rule is both spouses have to have earned income.
Exactly, unless one is deemed incapable of care.
Okay, on to pillar 2. This is about who's getting the care, the qualifying person test.
Two main categories here. First, a child who was under age 13 at the time the care was provided. Second, an incapacitated spouse or another tax dependent who is physically or mentally incapable of self-care.
And in both cases, they have to live with you for more than half the year.
Correct. That's the residency test.
I want to highlight the divorce nuance here because this comes up all the time.
It does. DCFSA eligibility is tied strictly to the custodial parent. That's the parent the child lived with for the greater number of nights in the year.
And this is important because it has nothing to do with who claims the child as a dependent on their tax return.
Absolutely nothing. It does not matter who claims the tax exemption. Only the custodial parent can use the DCFSA for that child's care.
That's a detail I think a lot of divorced parents miss. It's physical custody, not the tax form. Okay, pillar 3. This is the one that can cap high earners, the earned income limit.
Right, and this rule links right back to pillar 1. Your contribution limit is the lesser of three things: the statutory limit, your own earned income, or your spouse's earned income.
So what happens if a spouse is at home? Maybe they're a full-time student or they're incapacitated, they have zero earned income.
That's where the deemed income rule comes in. The IRS artificially deems their income to be $250 a month if you have one qualifying person,
Okay,
or $500 a month if you have two or more.
let's run a scenario. I earn $200,000. My spouse is a full-time student for the whole year, and we have one child. The statutory limit in 2026 will be $7,500. So what's my real cap?
Your real cap is based on your spouse's deemed income. So 250 times 12 months, that's $3,000.
Yeah.
Your family's entire DCFSA contribution is capped at $3,000 for the year.
So if I elected the full $7,500, I'd be in trouble.
You would. The extra $4,500 gets reclassified by the IRS as fully taxable income at the end of the year. It completely defeats the purpose. You have to check that lesser income rule first.
That is probably the single biggest financial trap in the DCFSA.
Let's shift to common ineligible expenses. The basic idea is custodial care is okay, but educational or medical care is not.
And this leads to the single most common reason for a denied claim, the kindergarten cutoff. Right. Tuition for kindergarten or any higher grade is not eligible. The IRS sees it as education.
Exactly, even if that school day provides care.
So if my child is in a private kindergarten and I also need before and after school care, how do I successfully claim just that after school portion?
The strategy here is what we call the unbundling strategy. You have to be proactive. Before the school year even starts, you need to talk to your provider and get an itemized receipt.
It can't just say tuition.
No. It has to clearly separate the eligible custodial care costs from the ineligible tuition. I've seen countless claims denied because the receipt just said tuition and fees $5,000.
Yeah.
You have to assume the auditor is going to be very skeptical.
Understood. Quick check on summer camps. Day camps are okay.
Yes, summer day camp is eligible. It's custodial care during work hours. But summer overnight camp is strictly ineligible.
And the logic there is?
The IRS says the overnight portion isn't a work-related expense. It's a personal enrichment choice, not something necessary for you to be at your job.
Got it. And finally, left confirmed for the sandwich generation. What about caring for adults?
Adult daycare or non-medical home care for an incapacitated spouse or dependent living with you is eligible. Just remember, if it's your spouse, that deemed income rule we just talked about still applies and will cap your contributions.
Okay. Now for what is honestly the most exciting news in this space in years, the statutory limit is changing. Big time. for plan years starting on or after January 1st, 2026.
It's a huge game changer. The limit for those married filing jointly is jumping from $5,000 to $7,500.
That's a 50% increase. That lets families shield so much more of their care costs from taxes.
It does. But,
Yeah.
and this is a big but, that $7,500 is a ceiling. It is not a guarantee.
Right. You mentioned an employer compliance trap. It involves something called non-discrimination testing, or NDT. Why does the IRS care if high earners use this benefit more than low earners?
The fairness principle here is that these tax advantage benefits have to be broadly available to the whole workforce, not just to what they call highly compensated employees or HCEs.
People earning over, what, $160,000 or so?
Generally, yeah. And the IRS has tests, like the 55% average benefits test, to make sure that's happening.
And if all the HCEs max out at $7,500, but the lower income employees don't really participate, the plan can fail that test.
Exactly, and the consequence is severe. If the plan fails NDT, the entire DCFSA contribution for those high earners becomes fully taxable. It totally defeats the purpose.
So to avoid that, an employer might just set their own plan limit lower than the $7,500.
They might be forced to, especially if they've struggled with compliance in the past. So the takeaway is you must check your specific 2026 plan documents.
This limit increase completely rewrites the strategic math when we compare the DCFSA to the other big benefit, the Child Independent Care Tax Credit, or CDCTC.
It really does. Historically, with the DCFSA capped to $5,000, the best strategy was often to use both.
You'd max out the DCFSA and then use the tax credit on the next $1,000 of expenses to hit its $6,000 limit.
Right. But now, in 2026, the DCFSA limit of $7,500 is higher than the CDCTC's expense limit of $6,000.
Which means
The strategic choice is now overwhelmingly clear for most middle and high-income earners. You maximize the DCFSA first. If you put $7,500 in your DCFSA, you can't also claim the tax credit because the DCFSA has already absorbed the entire $6,000 expense limit that the credit recognizes.
so you're shifting your entire $6,000 in expenses from a benefit that only reduces your income tax, the credit, to the DCFSA, which cuts your income tax, and that mandatory 7.65% FICA tax.
It's a clear dollar-for-dollar financial win every single time.
So to wrap this all up, the two biggest takeaways for you are, first, that dual tax shield, including the FICA avoidance, is just incredibly powerful.
And second, that 2026 limit increase makes maximizing the DCFSA the singular priority for most working families, provided, of course, your employer offers that full $7,500.
Because of those NDT compliance hurdles, you absolutely have to confirm the specific limit your company is offering during open enrollment for 2026.
And here's a final provocative thought for you to mull over. If the DCFSA is now clearly the better financial tool for almost everyone, and Congress raised its limit to $7,500, does the fact that the tax credit's expense cap is still stuck at a lower $6,000 effectively eliminate the credit for the very families it was designed to help?
Is the DCFSA now the only real game in town for subsidized care? That is a phenomenal point. Understanding how these systems work together is the first step to maximizing your financial health. That's all for this deep dive. We hope you feel better equipped to navigate these complicated regulations. We'll catch you next time.